Did you know that in 2021, the wealthiest 1% of Americans paid an effective tax rate of just 8.2%, while the average American faced a rate of 14%? It's surprising, right? This huge gap is not just luck, it's all about clever strategies that the rich use to minimize their tax bills. Many people believe that paying taxes is a given, but what if I told you that you could take a page from the playbook of the ultra-wealthy? They have mastered the art of tax avoidance legally, and you can too. In this video, we'll explore how billionaires like Warren Buffett and Elon Musk use loopholes and clever financial moves to keep more of their money. We'll dive into powerful strategies like charitable giving that not only help others but also reduce their taxes. We'll uncover the secrets behind trusts that protect their wealth and discover why passive income streams are a game changer. Stick around, and you'll learn actionable steps to start implementing these strategies in your own life. By the end, you'll see how understanding these techniques can help you keep more of your hard-earned money. Are you ready to uncover the truth about how the rich stay rich? Let's get started. Chapter 1. The legal loopholes billionaires love. Many billionaires pay less in taxes, as a percentage, than the average person. It might sound unfair, but it's all legal. Wealthy individuals use tax loopholes written into the law to reduce their tax bills. One famous example is Warren Buffett, who once revealed that he paid a lower tax rate than his secretary. How? Through something called capital gains. Capital gains are profits from selling assets like stocks, and they're taxed at a lower rate than regular income. For most people, this rate is around 15–20%, while regular income can be taxed as high as 37%. Rich people also use real estate to dodge taxes. They buy properties, then use depreciation, a deduction for the wear and tear on buildings, to lower their taxable income, even if the property's value actually goes up. The 1031 exchange is another trick they love. This allows them to sell real estate and immediately reinvest the proceeds into a similar property without paying taxes on the profits. It's like hitting pause on the tax bill, sometimes forever. The key here is that these loopholes aren't exclusive to billionaires. Anyone can use these strategies if they have the right assets. Learning about tax-advantaged investments can save you money, no matter how much you earn. Just make sure you're following the law. What's legal for one person is legal for all. Chapter 2. Mastering the art of tax deferral. Another big secret of the rich is tax deferral. It's a fancy term, but the concept is simple. Delay paying taxes as long as possible. The longer you keep your money growing, the more wealth you can accumulate before handing over a chunk to the IRS. The rich have perfected this strategy through tax-deferred accounts like 401ks and IRAs. These retirement accounts allow money to grow tax-free until it's withdrawn, often at retirement when you might be in a lower tax bracket. But the ultra-rich don't stop there. They use more advanced tools like deferred compensation plans, which allow them to postpone receiving part of their income until later, avoiding higher taxes now. And let's not forget about installment sales. This is when someone sells a large asset, like a business, but spreads out the payments and taxes over several years. Instead of being hit with a massive tax bill all at once, they chip away at it slowly. One of the more unique strategies is through opportunity zones. This was created in 2017 as part of the Tax Cuts and Jobs Act. By investing in these zones, which are often low-income areas, investors can defer taxes on profits until 2026 and avoid taxes altogether if they hold the investment for over 10 years. It's a win-win, tax savings and social impact. Chapter 3. Wealth shields. The power of tax havens. When most people hear tax havens, they think of shady offshore accounts. But for the rich, it's a completely legal and strategic way to protect their wealth. Tax havens are countries or regions with very low tax rates, or sometimes none at all. Places like Switzerland, the Cayman Islands, and Singapore are popular for this. These jurisdictions offer privacy and lower tax rates, making them perfect for high-net-worth individuals who want to reduce their tax exposure. But it's not just billionaires stashing cash overseas. Companies like Apple and Google use these same havens to shield billions in profits from US taxes. In 2021, Apple was reported to hold over $250 billion offshore to avoid US taxes. For individuals, One of the easiest ways to benefit from tax havens is through dual citizenship or residency programs. Countries like Portugal, Malta, and the Bahamas offer citizenship or residency to foreign investors, which can significantly reduce or even eliminate taxes on global income. And don't forget about foreign tax credits. If you live or invest in another country, you might be able to use the taxes you pay abroad to offset US taxes. The goal is to pay as little tax as possible, wherever you are. These strategies might sound exotic, but they're all perfectly legal. They just require knowledge of international tax laws and careful planning. And while you might not be moving to the Bahamas anytime soon, learning from these tactics can help you make smarter, more tax-efficient investments right where you are. If you're finding this information helpful, don't forget to subscribe. Stay tuned for more tips on how to grow your wealth and keep more of your money. Chapter 4. Charity or Strategy? How philanthropy saves millions. Many wealthy individuals aren't just giving to charity out of the goodness of their hearts. There's a strategic financial incentive behind it. Take Bill Gates or Jeff Bezos' ex-wife, Mackenzie Scott. These billionaires have donated billions, but they also enjoy massive tax breaks because of their generosity. The US tax system rewards charitable donations, allowing you to deduct up to 60% of your adjusted gross income, AGI, if you give to a qualified charity. But here's where it gets even more interesting. Instead of just donating cash, rich people often donate appreciated assets, like stocks. When they give stock instead of selling it, they avoid paying capital gains taxes on its appreciation, all while getting a full deduction for the stock's current market value. It's a win-win. They donate, get a deduction, and sidestep capital gains taxes. Another common tool for the wealthy is the Donor Advised Fund, DAF. Think of this as a personal charitable account. They can contribute assets to this fund, get an immediate tax deduction, and decide later which charities to give the money to. In 2022, DAFs reached nearly $230 billion in assets. This flexibility is incredibly attractive because they get the tax break up front but can take their time to decide on the charitable impact. You don't need millions to take advantage of these strategies, though. Even small donations, especially of appreciated stocks or other assets, can save you a nice chunk of change come tax season. By thinking like the wealthy, you can give back while saving more. Chapter 5. Trusts. The secret weapon of the ultra-rich. One of the biggest secrets of the wealthy when it comes to avoiding taxes is their use of trusts. Trusts are legal structures that hold and manage assets on behalf of beneficiaries. But they also serve as powerful tools for minimizing taxes, preserving wealth, and protecting privacy. According to the IRS, trusts accounted for over $120 billion in tax-exempt income in 2020. There are many types of trusts, but one that's particularly popular among the wealthy is the Grantor Retained Annuity Trust, GRAT. A GRAT allows wealthy individuals to transfer appreciating assets, like stocks or real estate, to heirs while significantly reducing the tax burden. The trust's creator receives annuity payments for a set period, and any remaining assets after this period pass to beneficiaries, tax-free. Facebook founder Mark Zuckerberg is said to have used GRATs to transfer millions to his heirs. Then, there's the Irrevocable Life Insurance Trust, ILIT. This trust holds life insurance policies and allows the wealthy to pass on large sums of money to heirs without them being subject to estate taxes. Given that estate taxes can be as high as 40%, it's a strategy that saves families millions. For regular investors, setting up a trust might seem complicated, but it's becoming more accessible. If you have valuable assets, like real estate or a family business, establishing a trust could help shield your wealth and ensure a smooth transfer to your heirs without hefty taxes. Trusts aren't just for the ultra-wealthy anymore. They're a smart move for anyone with a long-term view of their finances. If you enjoyed this content and want to learn more about smart financial strategies, don't forget to subscribe. Keep following us for more tips on how to grow your wealth and navigate the world of investing.